Good afternoon, everybody. Welcome. I want to thank you all for joining us. I want to thank the folks who are watching on the webcast and on C-SPAN today, and obviously the New America Foundation. Thank you for letting us do this event here today. Special thanks to Reed Kramer, who's the director of the Assets Program here. This idea was really his brainchild, and couldn't have gone on without him. The Assets Program has a lot of great material archived on its website at newamerica.net that you should really check out if any of this interests you. So we're here today to talk about the mortgage mess, which is tough to define, but it is sort of a return to form. When the financial crisis happened, when the housing bubble popped, we almost immediately got distracted by a lot of what was going on Wall Street. The last 2 years, we've seen a big financial reform effort that culminated in a regulatory overhaul there, but there hasn't been a ton of attention, or frankly, enough attention, in my view, devoted to what's happening on the ground with homeowners, troubled borrowers who are facing a huge foreclosure crisis. Those problems have not gone away in the intervening 2 years. 1 in 10 family residential mortgages is in foreclosure. 1 in 4 is underwater. And as many as 11 million more foreclosures will come before 2012. We've already seen 2.5 million. It's a huge issue, and it's a costly one, too. The Center for Responsible Lending estimates that of the 91.5 million households affected, the average loss is $20,000 in their assets. And if you look at the cost to local government, the Urban Institute reports it's about the same, $20,000 just to process a single foreclosure. And this is killing economic recovery. As long as consumers face huge debt overhangs, as long as they owe more money than their homes are owned, they're not going to be able to start spending. As long as banks have uncertainty about their balance sheets, we're not going to see more lending. And obviously we're building up a huge shadow inventory in the housing markets. It's keeping housing prices low, and it's keeping recovery from spreading across the country. And now, in the last 6 months, we've sort of received more clarity about a new economic problem. And I say new with some irony because we've had a lot of anecdotal reporting from legal aid lawyers and consumer advocates who've been seeing these problems on the ground. But really only in the last 6 months have big investigations revealed what's going on across the industry. And that is the famous robo-signer, which I hope you have heard of. But if you haven't, the robo-signer is a phenomenon of the mortgage servicing industry. Mortgage servicing sort of sprung up alongside securitization, the way we finance mortgages in this country by sort of chopping them up, combining them into complex investments and selling them either to federal government agencies or to private banks. And once this started happening, and we didn't have this old model where you would get a loan from your local bank and pay your local bank, someone had to deal with the payments. Someone was processing this. So mortgage servicers sprung up to collect payments from borrowers, pass them on to investors, manage foreclosures. And it all worked pretty well as long as it was automated, when there weren't a lot of foreclosures. But when the housing bubble popped and suddenly a lot of people were delinquent on their payments, foreclosures were happening, people wanted to negotiate with someone, the servicers were overwhelmed. And they started cutting corners to speed foreclosure. They started doing all kinds of pernicious practices. And at the same time, the government's main response to this was the Home Affordable Program, where essentially the Treasury asked the servicers, in exchange for essentially bribes, big cash payouts, to modify loans to affordable levels. That program has essentially been a failure. It has not met expectations. It's been really slow, and it's been blamed, again, on the servicers. Then, in this past summer, we encountered, like I said, the robo-signer. A loan officer for GMAC Financial testified that he had signed 10,000 affidavits a month testifying that his bank had the right to foreclose on homes. That's 1 a minute if you expect a 40-hour work week, and it's hard to believe that someone could review several months of a single borrower's payment history, do all the things you need to do to be legally sure that you can foreclose in that period. And it's become clear that these practices are widespread. How widespread, we don't know. Other practices like filing lost note affidavits when the notes have not been lost have sprung up. And it's become clear that corners have been cut across the board. And this doesn't mean necessarily that people don't end up having to pay their debt, but what it does mean is that we have serious uncertainty over whether or not who owns people's mortgage loans, who has standing to foreclose, who has standing to collect payments, and this could affect as many as 33 million mortgage loans. according to the Congressional Oversight Panel for TARP. 90% of mortgages in recent years were securitized, and it's incredibly widespread right now. And what it is a sign of is that all of the financial innovation we've seen in the housing markets and in the mortgage markets in the past years, it hasn't been matched with similar legal innovation. We've grafted this high-tech 21st century way of financing mortgages onto an old legal system. And it's more, I think, than just a kink in procedure, which is what a lot of these servicers will argue on a basic level. If you are taking away someone's property without due process and standing in the courts, that's a fundamental problem for the capitalist system. On a more straightforward level, when people in states pay for their mortgage loans, the costs of these bankruptcy procedures are figured in. People expect these protections, and when they're taken away, they're basically being defrauded. So this issue, the revelation of these practices, has come up with a couple different consequences. One is the 50 state attorney generals have launched an investigation into what's going on here, because clearly on the state level there are legal penalties, and it's clear that they want to try and do something to find a settlement that helps troubled homeowners while accessing the right amount of sanction to these servicers. But there's also broader things that are happening, openings for policy solutions to the foreclosure crisis. One of them is, again, we have this high-tech procedure that's not really being matched on the legal level. And across the country, there are meetings going on, mediation where borrowers and lenders are meeting with an independent third party. It's an old-fashioned solution to a new problem, and this sort of pervasive sense of injustice with the servicers is perhaps an opportunity for more mediation to scale up to a national level, and Alana's going to talk about that. And it's also revealed problems with the HAMP program and problems with Treasury's regulation of servicers through the various regulatory agencies, and with the fledgling Consumer Financial Protection Bureau that's going to be charged with watching this industry. And it's raised a lot of questions about what they need to do to make sure that that is working effectively. And then finally, as well as sort of creating problems in the housing market, creating uncertainty there, we're also seeing systemic risk issues where investors who bought these mortgage-backed securities are realizing that if the chain of ownership of these mortgages is not clear, maybe their securities are not in fact mortgage-backed. They're going to be suing the people who created these investments, attempting to shift those failing loans off their balance sheets back onto the balance sheets of banks that originated them. It's very unclear how much this could eventually cost those banks. It could be hundreds of billions of dollars, and that would be a serious threat to the health of the financial system because these banks are still weak, and losses of that magnitude could be very problematic. We don't really know the extent of these problems yet, except that they are pervasive and we don't know their consequences, but it is an opportunity to talk about how to fix these foreclosure issues, rebuild the housing market, and also look ahead to the future so that we don't see these things happen again. The servicing industry has sort of become more than just a middleman between borrowers and lenders. It's a middleman between our country and an economic recovery, and so hopefully the folks who are here with us today will come up with some good ideas to fix that problem. I just want to introduce the panelists before they come up and talk for a minute. We have Mike Consul with us, who is a former financial engineer. Now he is a fellow at the Roosevelt Institute. His writing on financial regulation and reform has been very influential in the last 2 years at his blog Rorty-Baum and also at the Roosevelt Institute. He's going to talk a little bit about, well, a whole bunch of stuff. He's going to do the basic rundown on securitization for us first. We're also joined by Alon Cohen, who is an attorney. He's been working with the Center for American Progress on their work on mediation for borrowers and lenders as a solution to the foreclosure problem. He'll talk about that. We have Julia Gordon with us. She is a senior policy counsel at the Center for Responsible Lending. She has worked on all of these issues for a long time at CRL, which is one of the biggest names in the world of consumer finance. And we also have with us Damon Silvers. He is the deputy chair of the Congressional Oversight Panel on TARP, which just released a major report on the issues in the mortgage servicing industry, and he's going to talk to us about a variety of issues related to the systemic risk factor. He is also the director of policy at the AFL-CIO. We're going to start with Mike. We're going to have everyone do a brief presentation. We're going to do a panel discussion and then round it out with questions. But for starters, here's Mike Consul.
Thank you. Get that. Well, I'd like to thank Tim and New America for hosting this very important and timely panel and for inviting me to speak. Excellent. I'm going to take 10 minutes and I want to explain three things. I want to talk about the origins of this crisis, where it comes from and what it entails. I want to tell you why you should care about it. And I want to start outlining some solutions and some of the incentives and motivations of many of the players right now who are trying to figure out the end goals of this. So to start, there you go. I'm going to assume people here and people watching at home have a real wide distribution of knowledge and familiarity with this crisis. So I'm going to start a little simple, and then we're going to get much more complicated quickly. Mortgage has two parts. It has a note and it has a lien. Right? The note is the actual debt. It's the IOU, the IOU money. The role of the note is to both explain the debt and explain terms associated with the debt. This is where you get late fees. Things that come up with distressed debt, things that come up with bankruptcy, and the things that show up in courts. The mortgage itself is, of course, just the lien. It basically says, it uses the collateral to say, if you don't pay your debts, we can take your home. Now, the note is something that's called a negotiable instrument. It's like a check. You can sign a check over to someone else on the back of it. The same thing happens with mortgages. In fact, it forms the basis of the securitization process. So this is a little complicated, but we'll walk through it. Securitization, a mortgage-backed security, a thing you've heard about so much in the past couple of years. It starts with the mortgage originator, like Countrywide. It creates a mortgage with the homeowner. It takes the note and other associated documents with that note, passes it to a sponsor. Sponsor is very often an investment bank like Bear Stearns. That sponsor then takes that documents and moves it to a depositor. This has to do with something called bankruptcy remote. We want to create a pure instrument of mortgages. We don't want you to have exposure to Bear Stearns or an investment bank. So through that process, those depositors then take those notes and those mortgages and turn them into a mortgage-backed security. Okay? Here's what has been happening, and right now trying to get our arms around how much of a systemic crisis this is really why we're holding these conferences. This comes from the Kemp case that just broke about a month ago, which said, Countrywide, as far as people understand who worked at Countrywide, were not passing these notes through. Okay? So why is that important? Well, it's important for two reasons, or it's important for three reasons. One is that they've signed things like pooling and service agreements. The actual infrastructure of the mortgage-backed security, the contracts everyone sign, requires the notes to be there as part of the due diligence. It requires the notes to be there as ultimately protection from lemons, protection from these things being constructed poorly. These are safeguards that investors rely on when they buy these things. The second has something to do with something called REMIC law. The servicers are a very thin business. They're designed to take money in on one side and walk it out the other side. They're meant to be what's considered a passive entity. So they're not supposed to be doing a lot of things. They're not supposed to be actively seeking out mortgages, actively looking for notes and buying notes and moving notes around. In fact, they have, for most of these contracts, they have about 90 days to get the notes in there. The third thing why this is relevant is that most of these mortgage-backed security contracts are formed under New York trust law, right? Trust law is a very strict law, and it's very strict law for good reason. We don't want people creating trust to go buy lunch or go do leverage buyouts or whatnot. We want it to be for very specific reasons. And the trust law is very specific that says these notes need to be passed through. The intentions don't matter. It doesn't matter that, there's nothing else we do with these notes. The contracts are very strict about this. Okay? So it's also worth stepping back and realizing that this system of organizing mortgages and organizing mortgage debt is brand new. People have had mortgages and people have had debt and people have had debt on property for centuries. But the system we interact with now is a brand new phenomenon. It comes out of the early 80s deregulation about extending the GSE model to the private capital markets. And as you can see, the leftmost point is 1980 and the rightmost point is 2010. And it's pretty much taken over the markets. It's never been stressed. It's never been tested like it has been right now. And what we are finding is that it is failing. So why is it failing? This is a complicated chart, and I encourage you. Diane Thompson of the National Consumer Law Center has this document. If you Google it, you can find it. But these are the various elements of the servicers, right? So to go back on, the servicers are the ones who are supposed to manage passively taking in money from the homeowners and putting it out to the mortgage-backed securities. When things go wrong, it's their job to manage it. And as we see, so much of the structural factors that go into both the contracts they sign, the institutional settings they operate in, and the personal and institutional motives and financial incentives that they encounter push towards foreclosure and push towards the speeding up of foreclosure. And this is a very complicated document. We can talk about it later if people have more questions, but that's the background, is that we have a system that's brand new. It's being tested and failing, and the default mode of it is to force people into foreclosure, even when there are negotiations that can be done. Okay. Now, when I say servicers, these are people with agency and institutions and political clout, and they're people like Bank of America, Wells Fargo, JP Morgan, people who've been through the stress test, people who've been through TARP, and it's a fairly concentrated market. Okay. So why should you care? This is homes underwater versus the unemployment rate. Perfect correlation. This is also the same chart if it was foreclosures versus the unemployment rates. And there's a lot of debate around macroeconomists. The IMF has done studies. Plenty of people are looking at this, but something about our persistently high unemployment rate has something to do with our persistently high amounts of mortgage debt and foreclosures. Okay. Consumers have been deleveraging for about 2 years now. They're net paying off debt. They're contracting. In response, the government is spending more and picking up some of this debt. And this kind of net leverage where everyone is trying to pay off the mortgage debt associated with the mortgage bubble and the credit bubble has been affecting our economy over the past 2 years. And it's very keyed into our recession. Now, about 2 years ago, people realized that there are kind of two policy initiatives that could make that run smoother. Having something that allows to correct for defects in our bankruptcy code, something called lien stripping, or more colloquially, mortgage cramdown. The other thing was to have some inflation, maybe 3% for many years. You had many people, Ken Rogoff, Greg Mankiw, people across the political spectrum calling for slightly higher level of inflation to deal with this overflow of debt. Neither of those things have happened. We're disinflating. There is no type of relief for mortgages in bankruptcy. And as such, most of this write-down in debt is coming through defaults and foreclosures. Now, foreclosures are lose-lose-lose events, right? The investor loses because the homeowner usually can pay something to stay in the home. The homeowner loses because he loses his home, he loses his standing in his community, he loses whatever institutional place he had. And then the community loses. There are well-documented spillover effects in good times to a foreclosure. They affect property values. If anyone has a foreclosure on your block, you probably are familiar with this. And in great times of exaggerated foreclosures, it obviously devastates neighborhoods, creates uncertainty about the way the mortgage market will ultimately clear. Okay, so let's get to the next part. So who are some of the players on the table? Now we're going to talk about different policy solutions that the government at the federal and state level can take on. But before we get there, let's talk a little bit about where the banks are coming from. One thing that the banks are worried about and should be worried about is that there's no quick legislative fix as far as anyone can tell. There is no equivalent of a weekend TARP where they could show up and say, if you could fix these 3 or 4 things, this will obviously not be a problem for the banks. Let's just pretend for a second we're bank lobbyists, a room of bank lobbyists, and we have 60 Senate votes. We don't have this. But if they did, it's not clear what they could pass to make this problem go away. They could modify the bankruptcy code to basically say that the note is no longer a problem, but bankruptcy is initiated by the consumer, not by the bank, in the sense that they don't pay. So the uncertainty associated with this, because so much of this is regulated through New York state law, means that the banks don't have an easy out for themselves. Now, even if they did, it's unlikely that Congress would vote for something like a TARP 2. Richard Shelby, noted conservative, has voted against immunizing MERS, which we'll talk about a little bit later, which means that that's very unlikely to pass. So it's not clear that the banks have like a silver bullet that they can use to make this go away. It's also uncertain that the banks understand themselves the extent of the problem. We saw this with if people follow this for a few months now, you may have noticed that many of the major banks put a short-term mortgage foreclosure moratorium in place, which was rescinded about a month later. It's not clear from the internal reviews they did that they got a sense of the scope of the problem that they have, the exposure they have. Because the one big problem, as Tim mentioned earlier, is that if these notes weren't passed through, you don't have a mortgage-backed security. You have an unsecured debt security. You have a security, a bond that has no mortgages in it because it does not have any notes in it. As such, because of those I mentioned the lemon law kind of stuff, the pooling and service agreements, the natural protection is to force the banks to then buy back the mortgages at par for 100 cents on the dollar, as opposed to the 20 or 30 or 40 cents it's worth now. That's a major amount of losses that is put back onto the balance sheets of those 6 largest banks we talked about. So right now, investors are meeting, and this is fairly well documented, they're meeting to try to figure out what their options are. Some have gone ahead with lawsuits demanding putbacks. It's tough to tell if this will be a wave. It'll either happen quickly or slowly. It'll either be a wave of hundreds of billions of dollars, or it'll be a trickle of 10, 20, $50 billion a year. Either way, the putbacks put a huge amount of systemic risk into the system. Now, federal regulators from day one have more or less run under the assumption that protecting the 6 largest banks has been crucial to the idea of stability, towards the idea of our economic growth, towards the idea of coming out of this recession. Whether or not that's a good or bad decision, they're running out of time to be able to do that. And if there is going to be a crisis, from their point of view, it's better for them to be in front of it. So there's now investigations going to start pulling random records out of these mortgage-backed securities to see if the notes are available. So other people are going to talk about what the attorney generals can do, but just very quickly, some of the things that the attorney generals are now being put into motion. First thing is that they're looking at criminal charges. This has not been discussed enough, but if crimes are committed, this can't just be an issue of civil court. Another thing they're doing is looking at actual defects in the servicing process. If payments are being made towards fees first, if the general service operationally is rotten, if there's a real problem in there through their software, through just the way that they operate, that needs to be fought at the state level. Now, for the past 10 years, through the work of federal preemption and a lot of the stuff that happened with the creation of the mortgage-backed security market, a lot of the attorney generals were put on the sideline. This was not an accident because the attorney generals were often very vocal advocates for consumer financial protection. With this crisis now, we're going to see them be put back into motion, investigating the securitizations, investigating the servicers, and I think that does show a real promise for a real new opening and possibility for change in this crisis. Thank you.
Thank you, Mike. Great. My name is Alon Cohen. I've been a consultant with the Center for American Progress for about 2.5 years now on housing issues, specifically to do with foreclosure mediation. I think Mike and Tim introduced it nicely. I'm going to give you an overview over the next 10 minutes of foreclosure mediation as one of the tools that can be very useful to turn, as what Mike described, a lose-lose-lose proposition into something that could be a win-win-win proposition. So let's start at the bottom with mediation itself. Mediation is a process in which the parties get into a room with a hopefully subject matter expert who is a neutral. That person's job is to understand the issues that are being discussed, but not to go one way or the other. And therefore, the basic idea about mediation is you do not have to settle. All we are asking is that the parties walk into the room and have a discussion. The reason this has always been an interesting piece of information for us is when the parties do get into the room, they settle. We got into a little trouble with this initially. People misunderstood our initial posture. We said, listen, if the folks who get into the room and discuss these foreclosures tend to settle, then why don't we tell everybody to do it? And we called that mandatory mediation. And of course, folks on the lender and servicer side said, well, then do I have to settle? And we said, no. You don't have to settle. You simply have to talk. And so we've evolved that term to automatic mediation. And what we mean more specifically is if you initiate a foreclosure, you, the lender, you, the servicer, then the body that is managing that foreclosure, whether it be the court or an organization that you've hired to do that for you, sends out a notice to both parties. Next Tuesday at 8 o'clock, show up at a particular location, mediate this case, and see if you can come up with a good deal. The reason that foreclosure mediation is important as one of the tools that should be involved in resolving the housing crisis is that it is a last best chance for the parties to get a chance to discuss this issue. And what we mean by a last best chance is before you lose your home, before we have to go worry about the second look process from Freddie Mac, before all that moves into place, let's have you speak. You, the homeowner, have likely gone to a housing counselor to attempt to get in touch with your lender and go through the process that feels an awful lot to most of us like calling your your cable company and seeing if you can change your service. You're going to talk to different people every time. They're not going to know your history. The paperwork gets lost. And this, in part, has been explained to us. And I think the term that Mike used, that servicers are a thin organization. These people built their business on doing high volumes at low overhead and having very little contact with users has been flipped on its head. And they have said, we simply, over the last 2.5 years, to many people's surprise, have not been able to hire enough people to handle the modification requests that have come down the pike. And the reason, this looks an awful lot like Mike's slide, the reason that mediation is successful is because it is a win-win-win. Homeowners want to walk in and have a conversation in which they can find an affordable way to keep their homes. Lenders have a fiduciary obligation to their investors, to their shareholders, to maximize the total value of the pool of mortgages that they hold, which means if a modification, a deed in lieu of foreclosure, a short sale can maximize that value, then that's the deal they're going to do. And more often than not, even with limits in their purchase and sale, in their servicing agreements, they're able to do that. And then lastly, when we go, as the Center for American Progress, other advocates, to a local government, they say, well, why are we going to get involved in this? What's in it for us? And of course, they very quickly see that, particularly a local government, a state government, where property taxes are king, that their tax base is eroding. And they want to make sure that they benefit from that, and then, of course, also lower their expenditures. When you have urban blight, when you have additional public services necessary, they're going to gain from making sure that their housing stock is as stable as possible. And finally, foreclosure mediation, offers a fail-safe process. HAMP is a paper-driven process. You send in information to the lender makes a determination, sends it back to you. If you sit in a room with somebody at the end of this process, I mentioned earlier Freddie Mac's second look process. That's 2 months down the line, 3 months down the line, 6 months down the line. And even then, it's only a select number of cases. The chances are, even if they pull yours up and there was a mistake, you've lost your home and you're not getting it back. If you get a chance to sit down ahead of time, you have a chance to have a conversation about your particular situation, see if the assumptions about your income, about your appraisal are correct. And if they are or not, perhaps you are eligible for a proprietary mod and so on. And lastly, you have the ability to find a process that rapidly injects certainty back into the process. The certainty that was shaken by the multi-state electronic registration system, the MERS system, the robo-signing crisis that Mike and Tim mentioned, these are things that have shaken the public trust in whether or not the person across the table from them actually has the right to foreclose. If a subject matter expert, as a housing counselor, a mediator, sits there and says, I see that they've crossed their I's and dotted their T's, that one person says, okay, I'm dealing with the right person, my foreclosure is proceeding as correctly, and that person goes and tells other people and other people and other people, and you rapidly rebuild certainty using this one tool. And of course, why do we want foreclosure mediation? Because it works. In a mature foreclosure mediation program such as the one in Connecticut and Philadelphia, we see a 74-75% settlement rate. And of that, the breakdown is that 60% of the people settling stay in their homes, 15% of the people engage in what we call graceful exit. It's a term we borrowed from Judge Rizzo in Philadelphia, and it refers to short sales, to deeds in lieu of foreclosure, cash for keys, other ways in which a homeowner leaves the home but has greater control, greater participation in that process, and again, gets greater value for the lenders and their investors and shareholders. We're also learning from those programs that mediation takes more than one session. Why? Homeowners don't have all their paperwork. Or the servicer or the lender needs to go back and get authorization and so on and so forth. And that those mediation sessions take 90, 100, 110 days, but tend to run in parallel with the foreclosure process. So the foreclosure process begins and starts to run its course, whether it's a waiting period or into discovery and so on. And in the meantime, mediation begins, and if mediation reaches a settlement, they both cease. And that tends to be a much shorter process than, for example, in New York, we are seeing about a year or a year and a half foreclosure process. This is an example of the sort of data we're getting out of states like Connecticut. This is from January, although they stayed fairly consistent. You can see, there's the laser pointer, 26% of participants did not settle, 14% engaged in a graceful exit, 60% manages to stay in their home. Connecticut is an interesting test case for us because it shows something that we found fascinating. If you create an opt-in mediation program, homeowner gets about a half-inch stack of paperwork that says you're being foreclosed on, you're also getting offers from private people saying, we can help you with a modification or we can help you in foreclosure, some of which are fraudulent. We'll leave that for another day. But those offers, amid those offers, there's a piece of paper that says, please check the box. If you'd like mediation, return that within 15 days. Make sure you get all your paperwork done and then show up for mediation. A lot of people don't get that done. But, that leads to a maximum participation rate throughout all the programs we've seen of 20%. So 1 in 5. What happens if you increase participation by going into an automatic system? Like we described, right? Everybody just gets a notice, show up. You get 80% participation. And what we worried about is, well, when you ramp that up, maybe the people who were opting in were self-selecting. These were the best people who would go in and go get themselves a modification. And it turns out not to be the case, and Connecticut showed us that. Connecticut went from an opt-in program early on and then went back to the legislature, said, this is working, give us an automatic program, give us some money, got $3 million out to the end of 2011, and has shown that previously 80%, Previously, 80% of people just weren't participating at all, which means in the raw number of total foreclosures, 12% of homeowners were keeping their homes. But when you go to an automatic program and 75% of people are in, then as a raw number of foreclosures, 45% of homeowners are keeping their homes. And the only difference is whether you have to opt in or opt out. And I think the New America Foundation is the right place to be talking about this because they themselves have leveraged behavioral economics to their advantage, and that is what Connecticut is doing, and that is what we encourage others to do. Now, to talk about foreclosure as and how one brings about these programs, foreclosure is a state process. The success of foreclosure mediation is evident in the fact that in 2009, when we looked at this, 11 jurisdictions had programs. There's an asterisk there because some of them didn't have mediation, they had negotiation. And in 2010, there were double that, 22 states, and most recently, the District of Columbia now has a program. The two major regimes of foreclosure in this country are judicial, where a case looks like a normal civil case and clogs up your civil docket, where you hear stories out of Florida about their rocket docket and 15-second hearings. And the other side is non-judicial foreclosure, in which there's an agreement in your note that says, if we want to foreclose on you because you've defaulted or for some other condition, then we can simply assign this to a trustee, he goes to sale, and we never see a courthouse. Now, the majority of states in this country have non-judicial foreclosure, but the majority of foreclosure mediation programs are in judicial foreclosure states. Why? Because judicial foreclosure states have a judiciary that doesn't need to go to the legislature and say, we want to create a program. They have discretion to simply divert cases into alternative dispute resolution modes if they need to. They've done it for years with family law successfully, and Philadelphia, among others, and Florida did it Florida statewide did that. They simply divert all cases into a mediation program. Now, if you need money, or if you're in a non-judicial foreclosure state, you got to go to your legislature and get an appropriation, get it passed. You got to have stakeholders and public hearings. A lot more complicated, which is why only 4 states has managed to do it. Notable among them is Nevada, which has one of the highest per capita foreclosure rates in the country. Notably missing is California, which still accounts for 20% of all foreclosures in the country and sorely needs a program like that. We have published extensively on states' best practices so far, and you can read in any of these in the 3 papers listed here. We've gone through the various steps one would want to take, and we've also reported on the successes and, let's call them shortcomings, of certain efforts across the country. Most recently, the Center for American Progress has published a memo on presidential power, and we are coming out with a 4th paper that goes through some of the things the federal government can do to support foreclosure mediation. We've been working on this for a while. The Vice President's foreclosure mediation, middle class task force came out with an announcement a month ago that said that community development block grant funds can be used to fund housing counselors supporting foreclosure mediation. Sounds pretty minor, but they are a linchpin. They're the subject matter expert who can come to a homeowner and says, let me explain the process to you, and then helps them through. And so that was a very important piece. Congress has had, as yet unsuccessful and in the new term, likely to continue to be unsuccessful legislation to help either fund programs at the state level or to simply direct, and this is the groups at the bottom of the page, FHA or FHFA as conservative for Fannie and Freddie to do the following, something that they can do already with their own powers, which is to direct their servicers. If you are servicing a government guaranteed, a government owned, a government backed loan, they can direct your loss mitigation efforts. They've done so already. Fannie has required in Florida that in any case that's going to go to foreclosure, you must first mediate. So before you ever get to court, you got to mediate first. So they've already exercised that power. Our message to them is, why don't you do that everywhere? Why don't you do that in California? Why don't you do that in Utah? Why don't you do that in Arizona? And suddenly we would have a national system whereby every case, or not every case, but a large chunk of cases is going to mediation. Thank you very much, and I'll pass it on to the next speaker.
Hi, thanks so much for having me here today. This has been mostly what I've been working on for the past several years, and it's always exciting to have an audience for it because these are very important issues. Of course, they're important systemically, but they are very, very important, as Tim mentioned, to the millions of homeowners who find themselves in trouble and who find themselves essentially ground up by a system that they never understood and had no hand in making. I want to start by just bringing up a topic I haven't discussed much publicly, but something Tim said struck me, which was in his opening remarks, he mentioned some of the problems we're seeing in mortgage servicing and said, of course, we'd heard these anecdotal reports from legal aid lawyers. So the question I want to pose today is, when legal aid lawyers handle thousands of cases, see certain problems over and over again and report them, why is that anecdotal? When either investors or banks themselves or regulators who are on a very delayed schedule finally looking at something reports the same problems, those are somehow not anecdotal. The reason I bring this up is the industry has been going down this road for a long time. These aren't problems that suddenly just sprang up that we didn't know about. And I think one lesson we can learn for the next time, because everyone is always looking for lessons out of these kind of debacles, is listen to the people who are closest to the ground. There are a lot of good early warning systems out there, and the legal aid lawyers tend to be one of them. They see these homeowners and they go through these papers very carefully, and they understood what was going on with the servicing system long before anybody else did. Speaking of the servicing system, this whole question of was the note properly endorsed? What's happening with the title? Were there, these boiler rooms full of people who were just robo-signing documents one after another? These are big problems, but what they are is they're emblematic of problems throughout the servicing system. And in many cases, what they do is the attention that's been drawn to them because they're so dramatic has taken a little bit of the focus off a major problem, which is in many cases, servicers are not keeping proper accounts for their customers, or in some cases, they are actively engaged in practices that will make it more likely for their customers to default on their home loans. So in any exploration of the problem and its solutions, we have to look all the way back through the servicing process. From the very beginning, how are the different payments accounted for? If a person is late, how are the late fees handled? When they do pay their account, in what order are those payments applied? Does the servicer first pay the mortgage, or do they first pay themselves for any late fees? Is the servicer improperly placing insurance on these loans when either the homeowner already has insurance, or if the homeowner doesn't, are they buying them insurance at wildly inflated rates because of a less than arm's length relationship with the insurer? These are problems that have been endemic throughout the servicing system for a long time, and in many cases result in a homeowner going into default not because they were unable to cover their basic mortgage payments, but because something happened in the servicing system that then spiraled out of control and ended up causing their default, as opposed to, in many cases, simply exacerbating their default. The next topic I want to touch on is the fact that we saw the housing bubble inflate. We've now seen it deflate. consequently, there are great economic losses out there. Nobody debates that there are losses. The only question is who is bearing the brunt of these losses. And so far, by spending the last 4 years failing to take on this problem in any effective way, what's happened is we, the people, have borne the brunt of these losses. Homeowners, communities, particularly minority communities, and anyone who lives either anywhere near foreclosure or, say, in a house that they own, has borne the brunt of these losses, as opposed to banks, or in some cases, even investors, although, of course, investors have seen a lot of losses too. For the most part, we have seen the banks treated very gently and protected at a level that a homeowner can only dream that someday their government would protect them at that level. So what I want to do now is talk about some solutions. I am not promising to talk about only the solutions that are the most politically feasible at this exact moment. Instead, what I'm going to do is talk about what I think is really going to work. Some of them I think are very feasible right now, and some of them need to happen anyway. First, in terms of servicing, if nothing else has become clear lately, it has become quite clear to everyone, I think no one will argue with this anymore, that one of the basic functions of the servicer is not being accomplished correctly, which is to sort out those foreclosures that should be avoided because it's in everybody's economic best interest to avoid them, as Alon talked about a little bit. And those foreclosures that are utterly unavoidable. Someone has absolutely no income, something catastrophic has happened. The system is not properly sorting those, and as a result, what we're having is a lot of what I call unnecessary foreclosures. In some cases, the homeowners are not even in default, or their default was servicer caused. In other cases, the homeowner is in default, but everybody would benefit from a loan modification of some kind. We need to get that system right, and one of the most important ways to do that is to end what's been a system of parallel processing, loss mitigation, and foreclosures. Right now, once your loan's in trouble, the computer systems in one part of the servicing organization, sometimes it's different subcontractors involved. The computer starts sending you a variety of letters at different times telling you how much trouble you're in at any given moment. At the same time as the right hand is doing that, the left hand may be engaging in some loss mitigation, meaning they may be talking with you about how to do a loan modification, how this foreclosure can be avoided. But the problem is the right and left hands aren't talking to each other. In many cases, they're prohibited by the contracts themselves from talking to each other. That has been pretty much a recipe for disaster. The homeowner's on the phone with their servicer and they think they're working out a deal. And all of a sudden they get this very legal-looking piece of paper in their mailbox talking about foreclosure or setting a sale date or something like that. Well, they naturally assume that their efforts to work out a deal haven't worked, and they proceed accordingly. This happens all the time. This is kind of insane. People have been referring to this as dual track processing. And one really effective way we can make mortgage servicing work better right now is to stop this dual track. And we need to stop it in two ways. One way is something that HAMP already requires, which is that a servicer should not be able to initiate foreclosure proceedings until a person has been reviewed for some kind of loan modification or loss mitigation solution. But reality being what it is, many homeowners don't actually contact their servicer until they have gone into the foreclosure process. And because of that reality, what is also crucial to do is that once a homeowner does contact a servicer, which is what all the servicers will tell you they want, at that moment, those foreclosure proceedings should be suspended until the review is completed. This is an automated review. It should not take that long to do. In a world of foreclosures taking a year and a half, it's really not going to move the dial one way or another, but it will make the sorting process a lot more effective to do this. One other thing I want to talk about, because I'm running out of time here, is this is the solution that may be on the more difficult political end, but unfortunately there's just no substitute for it, and that's for changing the bankruptcy code to permit bankruptcy judges to modify mortgages on principal residences. That is practically the only debt that bankruptcy judges can't modify right now. Bankruptcy is America's system for handling debt that's gone bad. We have the system for a reason. Debt is complicated. Restructuring debt is complicated. The bankruptcy system would permit us to handle all of the most difficult questions that come up in the loss mitigation process. We'd be able to handle the problem of second liens. We'd be able to handle the problem of very high, what they call back-end consumer debt, or consumers owing a lot of money on things besides their first mortgage. We'd be able to handle the problem of concern about whether different tranches of investors are going to be happy or unhappy with the outcome. And most of all, like with the mediation programs that Alon talked about, we'd have a disinterested third party available to oversee this entire process. We have been dancing around this issue for 4 years now. Every other solution you see put forward is an effort to basically create this system in some other way. So I would say, why don't we just use the system that was actually intended for this? The last point I want to make is that it is true that the government's HAMP program, their loan modification program, has been a serious disappointment and has not achieved what we had hoped for a variety of reasons, the most important being it's been a voluntary rather than a mandatory program, and the banks have been treated with kid gloves. But we have no other program right now. And so I would say having HAMP is an important tool right now. I don't think we want to see the government dismantle HAMP at this crucial moment. What we want to do is fix some of its flaws and put some other of these solutions in place as a backstop for borrowers so that we can get this right, stop the bleeding, and help begin to turn the situation around. Thanks so much.
Good afternoon. I'm Damon Silvers. As Tim said, I'm the Deputy Chair of the Congressional Oversight Panel for TARP. I'm also the Policy Director and Special Counsel to the President of the AFL-CIO. I'm required to say that my remarks are my own. They are not the opinion of the Congressional Oversight Panel as a body, or its staff, or its chair, Senator Ted Kaufman. These remarks are mine, although obviously I'm going to talk quite a bit about the work of the panel. I've been asked to address systemic issues raised by the presentations you've just heard. Let me begin by saying that our oversight panel has done regular reports on the mortgage crisis, dating back to it was our third or fourth report in March of 2009. Our most recent reports on these issues, the most recent one was issued a week ago, which really looks at HAMP and other programs under TARP for mitigating and preventing foreclosures. Perhaps of greatest relevance to this meeting is our report of our November 2010 report, last month's report, which looked directly at the question of a wide range of irregularities in the residential mortgage market and their likely implications from all sorts of dimensions. We have a particular interest, because we are the oversight panel for TARP, in sort of two dimensions of the purposes for which Congress enacted the Emergency Economic Stabilization Act of 2008, which is the TARP statute, known to many Americans as the bank bailout. The two purposes were to stabilize and repair our financial system, and specifically to address the foreclosure crisis. So we have looked at we looked at the irregularities issue through both those lenses. I have these two reports with me. They're very long. This is the December report. This is a two-sided copy, right, so you can imagine how long it is. They're both available on our website, which is www.cop.senate.gov. We've also held numerous hearings on the foreclosure crisis, including one, I guess, at the end of October, where Phyllis Caldwell, the head of HAMP, testified, and Julia testified at that hearing. We have held one hearing a year ago in 2009 in Philadelphia, where on the foreclosure crisis, where we particularly focused on the mediation programs that Alon was talking about in Philadelphia, and spent a lot of time with Judge Rizzo. Our oversight panel has consistently recommended, by the way, that I guess I got to learn the new term, automatic mediation, be a feature of federal policy in relation to foreclosures. And I think it's quite a mystery, given the kind of data that we saw today, and also given what certainly our panel witnessed firsthand as we observed a mass mediation session in the Philadelphia courts, led by Judge Rizzo. It's sort of a mystery why, in fact, so little has been done at the federal level to make this happen, and it's a good thing to see that some steps are being taken. Now, that's a big wind-up, and I'm going to talk about systemic risk. What is systemic risk? It's become a term of, the people seen the Google thing. You can search through Google and see how many times words are used throughout all of human civilization. I'm sure if you did that and you ran systemic risk, you would see that all of a sudden around 2007, it became perhaps as popular as Jimmy Carter or Marilyn Monroe, which were two terms that the New York Times reported that Google liked to search. So what is systemic risk? Because I don't think you can understand what the relationship of mortgage irregularities are to systemic risk unless you understand what it is we're talking about. Systemic risk is the notion that there is risk, the possibility of events that would destabilize, in particular, our financial system as a whole, but in a sense from the financial system to the economy as a whole. This is not the risk that a particular firm might fail, as painful as that might be for the people who are invested in or work for that firm, but the notion that there would be what is the possibility, the risk of contagion in the financial system. And historically, looking back to the Great Depression, there's been a lot of talk about systemic risk as a sort of a domino effect. One firm fails, it can't meet its obligations to other firms, those firms fail. What we saw in 2008 was that there's another type of system that, while that's very much a threat, there's also the systemic risk that comes from a sort of a collapse of confidence in the financial system, both as people learn things and also as participants in the financial system learn what they don't know. Meaning that when doubt comes into play as to whether or not major financial institutions that depend, for example, on short-term funding that's uninsured, when doubts about that arise, you can have a systemic crisis, even though there is not literally defaults triggering other defaults. Now, so what does this have to do with what we've just learned about? Now, it's important to note that what I'm talking about here is systemic risk. It is not the certainty of systemic crisis. Right? It's about probabilities, and there is no way to look at what you've just heard about, in my opinion, and not conclude, and I think this is a fair reading of our report, and not conclude that it raises issues of systemic risk, significant issues of systemic risk. Now, why is that? As at least one of the speakers noted, we have today a quite concentrated banking system compared to what most of us thought our banking system was, or what it was when we were all growing up. 62% of the assets of U.S. bank holding companies are held by four firms: Bank of America, J.P. Morgan Chase, Citigroup, and Wells Fargo. That's very high level of concentration historically. And it's mirrored by those firms' participation in the mortgage markets. Those four firms service 56% of all outstanding mortgages. They and their affiliates and subsidiaries originated 57% of all mortgages originated during the bubble period, and particularly during the 2005 to 2007 period. How much money are we talking about? Those four firms service mortgages with principal amounts of close to $6 trillion. They originated mortgages just during the 2005 to 2007 period of close to $5 trillion. Now, one of the things about financial policy is that the numbers involved tend to be kind of mind-numbing. What does that mean, $5 trillion? How much is that? Well, this is the important thing to keep in mind. The total Tier 1 regulatory capital, which is one of the key measures of the solvency of banks, the total Tier 1 regulatory capital of those four institutions is $535 billion. That is approximately 1/10 of the principal of the mortgages they both originated and serviced. Now, so what does that mean? 1/10, is that big, little? What are the implications? Well, long before you get to zero regulatory capital, a bank will be destabilized. And particularly these very large integrated universal banks that don't just depend on insured deposits, but depend on a variety of short-term funding mechanisms, as we learned during the crash in 2008. Long before you get to zero regulatory capital, you will have solvency problems with banks. Those four institutions are each undoubtedly systemically significant. If any one of them were to be destabilized, it would create both domino effects and it would create doubts about the viability of other institutions, doubts that could not be easily answered. In addition, as I think you've learned from the other presenters, and as you will find if you look in our report, the nature of the irregularities in the mortgage market is that it's very hard to figure out exactly what is going on. It is hard to figure out what the facts are, the basic facts about where are the documents. It is very hard to determine what the legal meaning of the facts are, given that legal meaning is going to be subject to separate proceedings in all 50 states, and potentially within the 50 states, separate proceedings in different counties. It's a classic sort of situation that would lead somebody to conclude, I don't know what's going on with this firm and these irregularities, and therefore I'm pulling my money. Whatever the real systemic risks are, whatever the real financial risks are, this issue of uncertainty, right, it layers on top of that and exacerbates it. And that type of uncertainty with respect to the mortgage crisis was critical to the way in which the financial crisis of 2008 evolved. So that you have both the hard numbers to the extent we can figure them out, and then you have the risk that that financial market participants could conclude that we have too many unknown unknowns here. Now, I'm going to conclude by walking through with you a little bit of math, all right, in order to explain to you the nature of why I believe that this is undoubtedly an issue of systemic risk. There are different measures of capital for banks. I'm going to shift from Tier 1 capital I just mentioned to market capitalization. Today, you could, if you could somehow figure out how to do it without triggering a run-up in the stock price, you could buy a Bank of America for about $120 billion. That's about what the stock of Bank of America is worth, all of it. And that's roughly what the markets, that's a sort of approximation of what the markets think the equity is worth. If Bank of America starts taking losses, those losses nobody in the markets expect, it would start subtracting from that value. Now, Bank of America is the biggest of the servicing banks, with about 20% of the market that I just described. Close to, it's close to $2 trillion that they have in terms of both originated and serviced securities. The Federal Reserve Bank of New York and a group of other bond investors have began the process of trying to force Bank of America to buy back from them mortgages that Bank of America had securitized, and they had bought the securitizations. They're looking for $47 billion. They're looking at a $47 billion pool of mortgages. The bondholders believe that $47 billion pool as a whole is worth on the market today about half of its face value. So if you imagine that you took all those mortgages, there are tens of thousands of them, all $47 billion worth nominally, and if you were able to force Bank of America to buy them all back, Bank of America would take an instantaneous 50% loss on that transaction, which would be $23 billion loss. But remember, this is not being done as a block. It's being done mortgage by mortgage. And which mortgages do you think they're going to want to put back in a pool that's worth 50% as a whole? It's likely to be the bad ones. Now, how many of those transactions, how many such putbacks could Bank of America absorb? Well, maybe $100 billion if it's a 50% haircut, $100 billion worth of putbacks. Maybe a little more, maybe a lot less. How many putbacks will investors be able to force on Bank of America? Completely unclear. Analysts who've looked at this using largely bank data have estimated much smaller estimates. But you can see that just taking that one block of bonds, which the bondholders view as not particularly remarkable, you multiply. It doesn't take very many multiples to get to a really, really big capital problem. And remember what I said a moment ago. Bank of America has $2 trillion in originated and serviced loans, roughly. That's why there is an issue of systemic risk. How big an issue? What is the percentage likelihood that these events would produce some sort of systemic crisis, either across the system or because of the weakness of one large systemically significant institution? Our panel was unable to assign a percentage likelihood. But we concluded, and we got tons of, hundreds of pages of explanation as to why we concluded this. We concluded that the risk is there. Now, I'm running over. I'm going to say two more things. And not two more long paragraphs, but two more thoughts. The first thought is, it's been troubling to me, and I think to our panel, that it's been very difficult for the bodies assigned to manage and prevent the growth of systemic risk, and particularly the bodies created by the Dodd-Frank Act, to speak candidly about this. Systemic risk appears to be a term. We've built a regulatory structure to try to prevent systemic risk from escalating. We've empowered them to take a variety of actions to essentially restrain financial market participants from building up systemic risk. All those kinds of powers depend upon being able to identify practices that increase systemic risk. And yet, when faced with a very clear matter that puts these issues in play, the regulators are afraid to say the words. Makes you wonder how the system's going to function. Right? If we can't admit that, how can we manage risks we can't admit we have? Second and final point. As several of the other speakers have mentioned, the irregularities are not the only source of systemic risk here. It may be true that the irregularities are in fact not a source of systemic risk. But if they're not, here's what is. 200,000 plus foreclosures every month, as far as the eye can see. Why is that a systemic risk? A, because it will eventually force the write-down of assets that are currently being carried on assumptions by banks on assumptions that housing prices are going to rise. Housing prices are not going to rise until those extraordinary levels of foreclosures stop. And secondly, it's a systemic risk because of what it does, not to our financial system, but to our economy, to consumer demand, to the social fabric of our country, and in certain respects, to the confidence of our citizenry in the fairness and effectiveness of our legal and political systems, which has consequences for our ability to manage economic policy. So there are systemic risks that everybody's arguing about, and then there are systemic risks that nobody's really arguing about, but are equally real, and in some ways more clearly evident and more clearly unavoidable at this point. And so the challenge, so the notion, and I'm going to wind up here by talking something about TARP. The notion that TARP has been a success is a hotly debated one here in Washington. And our panel, I think, on a bipartisan basis, has taken the view that TARP was a fairly successful program in dealing with a very acute crisis in 2008, in stopping a panic, but much, much less successful in its purposes of leaving us with a healthy financial system or addressing the mortgage crisis, and those two things appear to be deeply intertwined. And that issue of the long-term health of our financial system and our economy is turning out to have quite a bit of bite. And it's long overdue that more aggressive and focused actions be taken. And certainly the suggestions around mediation are part of those actions, but there's a real punchline to this ultimately that I think we really have to face, which is that the losses here are real. They're very large, they're very real. And as long as there's an effort to kind of not assign them here or there, but pretend that they don't exist, the more paralysis we're going to have both in our economy and in our housing system. And there may not be any real way of dealing with these issues fundamentally without dealing with the fact that one way or another there have to be consequences for financial institutions for the mistakes they made. And whether or not those mistakes include massive abuse of the legal system is a question we'll have to wait on, but there's no question that those mistakes gave rise to trillions of dollars of losses in our economy, which we're paying for and continue to pay for. Thank you.
So thanks to our four panelists for talking for a minute about their perspectives on this. We're going to have a brief sort of panel discussion before we open it up to audience questions. I wanted to start, we've had a few references to the Dodd-Frank financial reform bill that passed this year, and I just wanted to talk from a regulatory perspective, who is actually going to be in charge of monitoring the servicers under this new regulatory regime, and what are sort of the first steps that they should be taking to start addressing these problems going forward? And anyone can jump in on that who has an opinion.
But very quickly, right now the servicers are not regulated qua servicers. They're regulated if they're a part of a commercial bank, which many of them are. But if you look, Mother Jones has written about this, a lot of others have written about it. There's essentially been no regulatory action against servicers in the past 10 years. OCC in particular, which now owns that jurisdiction, has not taken any actions. It'll move to the CFPB. The SEC right now is looking at rule writing about the securitization process. There is a letter that just went active today. I'm blanking on who put it out. I know Josh Rosner was, I think, a signer on it. Rob Johnson of the Roosevelt Institute, where I work, was a signer on it. That said that this servicer risk has to be part of the risk profile of large banks. And I think that's, as we see these put-back issues, well, I see that's going to be very relevant.
I just want to add to that it definitely falls to the CFPB, the new Consumer Financial Protection Agency, to write industry-wide rules for servicers to abide by, and we believe that should be very high on the priority list when the agency comes online in July. July isn't very far away. It's a good time to start looking at this right now. Right now there's a joint rulemaking going on with respect to the mortgage risk retention system set up by the Dodd-Frank Act, wherein securitizers of mortgages have to continue to hold some amount of the risk of that which they securitize. And there is a broad-based effort right now to put some servicing standards into that system. They're very much needed industry-wide, but in particular, we know that servicing securitized loans carries a variety of difficulties, even more so than servicing portfolio loans. And the robust oversight of servicers is long overdue and should certainly be on the agenda of any regulator that touches the system in any way, including the prudential regulators.
Just to sort of put a finer point on what people have just said, I think it's important to understand that the answer to that question is that there are at least three distinct sort of regulatory jurisdictions over servicing. One is the consumer jurisdiction that Julia just mentioned, which is the CFPB. The second is the SEC, which Mike talked about, which is really focused on investors, both investors in the stocks and bonds of the banks themselves, of the servicers, but also investors in publicly traded mortgage-backed securities that the servicer services, so to speak. And the third, and perhaps the most important and least focused on, are the bank regulators, whose purpose, the FDIC, the OCC, and the Federal Reserve, each of which have a jurisdiction over the large servicing companies. They're in different ways, and their purpose is the solvency of those institutions. It's really, and they have a variety of risk-based capital requirements, and these issues clearly intertwine with them. One of the most salient issues that's going to come up very fast here is that the Federal Reserve is going to be running stress tests on the major banks again. Now, the results of those stress tests are not going to be public, but it does seem quite clear that they're going to be looking at the mortgage irregularities as a sort of contributing data points to those tests.
I wanted to ask a bigger picture question as well. Mike showed us that graph that demonstrated that this is a relatively new model for housing finance, and it's grown exponentially in the last 20 years. It's not living up to its first test. In the next year, Congress is expected to take up GSE reform. They're going to look at Fannie Mae and Freddie Mac. Is this a model that can continue securitization of mortgages with all of the risks that's inherent in it, or is there a different way to approach it? What should we look for in the next year when we're talking about fixing the GSEs where this process sort of originated?
I'll jump in on this for lack of
too
enthusiasm. I'll fight my way to the front of the herd. And I'm going to answer this by first admitting that I'm going to answer this question sideways, which is to say I'm not going to hit it head on and tell you whether we should be reviewing. I'm going to say if you believe in what the GSEs were set up to do, namely promote home ownership, then you should keep them in a modified version of what they are today. If you believe that the GSEs are an improper method by which you can do this, then you should get rid of them altogether. And I think that that's sort of the basic split on GSEs. Right now they have been a punching bag, and they have not done everything correctly, but by and large, if one takes a look and faults the GSEs, most of the time they are being faulted for doing that which they were set up to do. And so if you are going to attack them as to their fundamental purpose, then let's do that and be honest about it. The other suggestions, incidentally, that are coming to the fore here are, well, what do we do instead of a GSE? And some of the suggestions have been, well, let's forget about government subsidy of mortgage finance. Let's just go to private mortgage rates. And my colleague David Min did some work on going back and simply saying, well, let's look at what was being done when we had purely private mortgage finance. And let's look at the rate of home ownership, and let's look at the usurious, potentially, rates that people were paying, and let's look at the rate at which people were able to buy homes. And I think that when we take a hard look at this and our own expectations about participating in the economy as consumers, as homeowners, that we don't like that world. And so we come down on a notion where if we ask the GSEs to do something and we didn't like the world that created, then let's move them in a direction that we like, but let's not get rid of them altogether. So like I said, I've just addressed the question sideways.
I'm sorry. There's a number of very ironic things about the discussion. There's a number of very ironic things about the discussion about GSEs. The first is you might think that there's evidence that the GSEs caused the mortgage crisis. And actually the evidence suggests that they were a secondary actor. It doesn't just suggest it, it proves it pretty much definitively, meaning that the subprime bubble got going in the private non-GSE supported markets. And the GSEs, which at that point had been essentially privatized and whose executives had the type of incentive structures for themselves that other private financial institutions had. The GSEs became very concerned both about market share and profitability, and they chased the private lenders. Right, so that you see big private lending in alt-A and subprime in 2003 and 2004, and the GSEs come in 2004 for Fannie Mae, and in 2005 and 2006 for Freddie Mac. All right, so if there's some notion here that the GSEs set this thing in motion, it's not true. Secondly, now that doesn't mean the GSEs aren't culpable for the fact that they bankrupted themselves, but it's not true that this crisis was caused by the GSEs. Secondly, the GSEs have existed since the New Deal, and we only had this kind of situation in our mortgage markets in the last 5 years, in the last 5 to 7 years. So what does that tell us? Does it tell us that there's something fundamentally problematic about essentially a financial institution intermediating tail risk for mortgages? No, it tells us that there's something fundamentally problematic about that institution having its executives compensated on short-term financial performance metrics and having them play catch-up to a completely unregulated private system. Now, the conclusion to those points, so then here's the other. So the whole narrative about GSEs that's out there about them being a central cause here, not a secondary cause, but a central cause, simply has no factual support. Secondly, there's a great political irony here. The major Wall Street institutions spent a lot of money over the last 20 years attacking the GSEs. They had whole committees and lobbyists and so forth out there doing that, and there was plenty to attack them for. I'm not suggesting that they're blameless in all this. But they spent a lot of time attacking them because they wanted essentially to be able to operate in that space without GSE competition. When the financial crisis happened, those politicians that had bought into free market fundamentalism, right, were looking for an explanation that didn't slit their own throats for what had just happened, and they happened upon the GSEs, and they thought that would be something the banks would like and support financially, that explanation. Ironically, what then happened is that the market, investors, walked completely away from privately issued mortgage-backed securities. So that starting in the winter of 2009, and it's still true today, private financial institutions cannot securitize mortgages without the GSEs. As a result, there was no longer any appetite on the part of the major banks for dismantling the GSEs. And so we are now in this funny sort of context in which the rhetoric and the ideology and the power politics are completely sort of at cross purposes with each other.
Very quickly, one way to think about what the GSEs do goes back to securitization, and that actually, the securitization market comes from the GSEs, which put in prime loans. This is where the whole definition of subprime comes from, is the stuff that the GSEs wouldn't touch. A lot of the early 80s deregulation came from removing state laws that interfered with the private creation of securitization. So the GSEs, one way to think about them is what goes into securitizations. And, it turns out that if you stuff them full of really bad loans, you're going to have bad outcomes. The GSEs exist in part to put in prime loans and kind of stamp them as being prime, and they absorb some of the credit risk. So that's how that comes about. Now the question is, it doesn't seem like that can exist on its own. Every industrialized country has some sort of mechanism to regulate housing lending, and it seems that historically housing will not be a very good way of building assets or building any type of equity without some sort of government backstop, a 30-year mortgage and so on and so forth. They'll look a lot shorter and a lot more like a bullet loan. So the question is, what kind of, do we want to build equity through home ownership in the future is the real question.
I just want to bring this discussion back around to the foreclosure problem and the servicing issues that we've been discussing today, because I think my colleagues here have covered some of the basics on the GSE question pretty well, which is no matter what kind of housing finance system we have, what we've learned from this crisis is that we need to do a much better job of understanding how the incentive structures work and in what places there are incentives that may not be very transparent that cause us to be pricing risk incorrectly. The predatory lending that we saw that was a big part of how we ended up with this housing crisis came because we took a system of mortgage lending where it had been in the bank's interest to locate borrowers who were capable of paying their mortgage back, and turned it into a system where independent mortgage brokers got paid at the closing table, and where originating lenders sold the loans out in a matter of weeks, and where, as you saw from Mike's chart, there was a long process designed to strip off every bit of liability. So there were very few incentives there for good mortgages to be made. Now what we're learning about is the other side of that, how on the mortgage servicing end, there are also all these incentives built in that do not aim toward the maximization of the best interests of either the investors or the homeowner, but in many cases just the servicer, the entity that's actually doing the work there, and that that's why we need real oversight, real transparency, and particularly, I would suggest that we pay particular attention to anything we do that, say, purports to throw away a land title system that's been there for thousands of years. When you're doing something like that, it needs to be done with some serious thought and attention.
Let me just ask one thing. Go ahead. One of the conflicts of interest that I think people have not talked a lot about has been the second lien problem, and I wondered if someone might address that for a minute. I don't know if you can, Alon, or someone else.
You want to jump
Well,
in?
a number of us here can talk about it, but there are about 50, estimates differ, but probably around half of all mortgages in trouble have an additional lien on them, either a second mortgage that was taken out or a home equity line of credit. Many of those second liens were what we call piggyback loans, meaning they were taken out simultaneously at the time of origination to try to avoid any requirements for private mortgage insurance. Some of them are just your typical, home equity lines of credit that you get later to pay to fix your roof or whatever you're going to do. Most of these second liens are held in the portfolios of the large banks that Damon and Mike have been talking about. Now, you'll recall that those banks are the same banks that own the servicers that service the majority of the mortgage loans out there. And you might think, isn't that a conflict of interest? Well, turns out, yes, it is a conflict of interest. Exactly how the conflict works differs depending on who you ask. But essentially, an investor in a first lien mortgage, which is supposed to have priority, that's why they call it a first lien, doesn't particularly want to see their lien impaired when a second lien on that mortgage, something that's supposed to be a junior lien, something that's supposed to take any hit first, when that lien is remaining unimpaired. And that has been a major obstacle to everything that we have tried to do from the government's point of view to solve the foreclosure problem. Ranging just from basic loan modification efforts to any kind of program designed to reduce principal, either for borrowers who are already in default or for borrowers who are current, and as well as for solutions where the homeowner needs to exit the home, a short sale or a deed in lieu. The second, and in some cases third, liens gum up the works, and that's where much of the most, let's say, optimistic accounting is going on, in that banks continue to hold many of these second liens on their books at their original value, in this hope that, well, if we just stick it out, these prices will go back up, and phew, we won't have to take that large markdown. And so in the case of second liens, they've been a big problem, and in a sense, they've been a central problem to addressing this issue, and it's an interesting situation where policy is being driven by accounting rules.
We're running out of time a little bit, so I'm going to ask just briefly for you all to say, just in one or two sentences, what the top priority should be for policymakers in the next 6 months to deal with these problems. And then we're going to take just a few questions from the audience, so think about those. So go ahead.
Well, I won't suggest any specific policy outside that. Cram down takes care of pretty much all these problems, including the second lien, including notes, including everything else. I will note one thing we don't have a handle on is the foreclosure costs municipality about $20,000, depending. There's estimates on this. 3 foreclosures is a teacher's salary. So at a point where municipalities are contracting and shutting down schools, not fixing roads, cutting power, cutting salaries, they're going to have to pay the largest banks for these foreclosures. That's an abomination.
Well, I think from the beginning here, I've had a particular policy position regarding foreclosure mediation, and therefore admitting from the get-go that this is a piece of the solution to the housing crisis, not the entirety. I would say if you're going to spend a relatively modest sum then spend it on mediation, because while the rest of these things are getting started, right, we're talking until next July before the CFPB gets going, and then they have to go through their rulemaking. We're talking about a year and a half out before the rubber meets the road. Foreclosure mediation is already rolling in many of these places, and federal support gives you that, as I mentioned, the last best chance for a homeowner who's losing his house in the next month or 2 months or 3 months to see that home either saved or transferred in a higher value transaction and given greater control over the process. So, I am in some sense dealing in real politic here, but I say, we have proposed if you were to do a federal matching funds legislation of about $800 million, you should be able to fund to 50% a program in every major metropolitan area in the country. That's one example. I don't believe that that's getting done in the next 6 months, but that is the level of funding we're talking about, and $800 million in the scope of the discussions we've been having. I'm not even in the same denomination as some of the rest of the conversations, right, in the billions and the trillions. So,
for a long list of potential solutions, I would refer you to testimony that I've given recently before both the Congressional Oversight Panel and the House Financial Services Committee, and that can be found on our website at responsiblelending.org. But here's what I'll say about any solution. We know what we need, which is something, in order to get this right, any program that we put out needs to be mandatory, needs to be industry-wide, and needs to give the homeowner some level of control or have a third party involved so that the decisions aren't entirely being made by the servicer without the homeowner having any right to appeal or any ability to bring someone else in for help. By way of money, I will just suggest that one of the best ways to make a very small amount of money go very far is to fund legal aid attorneys. I realize you're shocked I just said that, but there is an enormous multiplier effect of that money on just a few million a year. These are the attorneys that have brought you all of the information about robo-signing and about the title problems, and who are doing some of these innovative lawsuits in courts right now. These are attorneys who work for their clients for free, who practically work for free themselves, in some cases actually work for free themselves. And there was money authorized in the Dodd-Frank Act for these attorneys, but it was not appropriated. It looks like it will not be appropriated. So to the extent there is money in any pool from any kind of settlement or from any state or municipal program, I would strongly suggest that legal aid lawyers be part of the mix.
I think that if you look at the policy notions that have been on the table this afternoon, what they're all about is different routes to principal modification, to rewriting loans so that people can stay in homes. And now, I think there ought to be a policy goal associated with this, which is to get the foreclosure rate to a level where it is not exerting meaningful downward pressure on housing prices for all Americans. And I think in order to get policies in place that do that, we have to stop being confused about two basic facts about the foreclosure crisis, which have been an obsession of mine in relationship to my service on the COP committee in the last few months. And the first is there ought not to be any confusion on the part of any policymaker that foreclosures are bad. They are bad for our economy. They are bad for the citizenry generally. They are bad for our country. Secondly, there ought not to be any confusion that the foreclosure crisis, including the irregularities, is a serious source of both financial and economic systemic risk.
All right. I think we have time for Two questions. So we have a microphone. I'm going to ask that everybody can identify themselves, and please phrase your question as a question, and quickly, please, and the gentleman with the blue sleeve right there.
To Mr. Cohen, you were talking about your suggestion. What is preventing the leadership in the Senate and the House from embracing your simple suggestion, given what's happening in Connecticut and wherever it was, with the best practices so far?
I think that there have been bills in the Senate and the House that have gone, into committee and stayed in committee. I think both bodies have been very busy with other more high priority issues. This is viewed as being something that states are already taking care of or could take care of. I think there's been tremendous receptivity among the policy initiate to understand what how this could help. It does not resonate. And the concern is that if you, be perfectly blunt here, if you raise your head above the weeds here, that it will be chopped off, because the idea, as I mentioned, we said mandatory mediation, people said mandated settlement, even though that's not the case. And we bring up federal legislation and people say contracts clause. And we say, no, it's clearly not the case, particularly if you're funding a state program that then the states enact and the contracts clause doesn't apply there, and so on and so forth. So there are talking point objections that are not true objections that people are concerned they will not see here. And then with the new leadership coming into the House, I think the position of the Mortgage Bankers Association, the banks in general, is going to be such that it would be difficult, given their state-by-state objection to this, for this to pass. And I will say this, to their credit, in those states, including, incidentally, in Philadelphia, in Connecticut, in Florida, Maryland, in D.C., while they have objected when the process has started, once the process is up and running, once foreclosure mediation is ongoing, as stakeholders in the creation of it, they have oftentimes embraced it, seen the savings that it creates for them, and are active participants in the process. That creates the mystery as to why in every new state there's the objection, but I think that was addressed by Julia's comment regarding this dual track system. I think the description that a former colleague of mine, Andrew Jakovics, liked to use is of the octopus. When you have an organization this large, what one part is doing and what another part is doing are totally unrelated. These people sit in different geographic locations. They don't know each other. And I think that the reality here is there's just simply a dislocation between the people who are acting in, say, Tennessee or wherever it is and are opposed, whereas somebody acting in Florida who is for because they've seen it on the ground.
I think we have time for just one last question, if anyone has one.
Up here.
This gentleman up here. Please identify yourself and keep it brief and a question, because we all have to run.
Al Milliken, AM Media. Do any of you have any statistical or anecdotal information on incidents involving violence during foreclosure mediation or foreclosure situations where no mediation has taken place?
I mean, I have the way our research is done is both systematic and anecdotal, in that we will go and have conversations, and I have not heard. I believe I've seen one media report in one instance in which there was an altercation, and I do not recall and I believe it was related to foreclosure, not to foreclosure mediation, but I have not heard of any instances from those people I've spoken to in any program. If one is to see the least contentious system that one could imagine in this situation, where a homeowner is under tremendous stress, and incidentally, so is servicer's counsel. That person oftentimes has 100, 200, 300 cases they're dealing with, and is under tremendous stress to get them done as quickly as possible, which is a pressure that Julia talked about. That is a system that should be a pressure cooker, and yet when you bring it into a formal context in a mediation, that system, that process, is meant to alleviate those tensions, and they tend to be very amicable.
The only thing I know of in that vein are suicides.
Well, on that note, let's hope it doesn't come to that. Thank you all so much for joining us today, and have a lovely holiday.